What's up everybody, GenExDividendInvestor here. In this video I'm going to analyze a subscriber's dividend portfolio that was sent to me asking for my feedback. Then I'm going to follow Tinder's lead and swipe right if I like the portfolio enough to use it as my own, or left if I wouldn't. If you're new to me but are interested in dividends, then please consider subscribing to my channel and clicking the bell notification to be alerted when I make new videos. Also, if you could tap that like button, then there's a very real possibility that you will be graced with 10 years of good luck. Finally, I'm not a professional wealth manager, so don't take anything I say as financial advice. I'm just someone who is passionate about dividend investing and helping others on their journey. I plan to run a poll on the community tab of my YouTube channel so that you can vote on if you like or dislike this portfolio. That way we can see how everyone feels about it, not just me. In my last portfolio review, I swiped the portfolio to the right, and then 365 of you voted on my community tab, and 40% of the voters said that they would also date the portfolio. But 60% of you said you had enough dating and instead just wanted to stay home and play Madden. I get it. So now let's see what we think about this new portfolio that was just sent to me from a subscriber named Michael. I've gotten tons of requests to review people's portfolios, so I'm sorry I can't get to these faster. Michael said, "Love your videos and your extensive knowledge into the companies you invest in. I would love your insights into my 3-year-old $30,000 portfolio." Thanks, Michael. I appreciate you saying that. I have lots to learn myself, but I love getting the opportunity to hopefully positively influence people. Michael shared a link to his $30,000 M1 portfolio. It's awesome you're investing, Michael. Keep that trend up for decades and it should dramatically change your financial future's life trajectory, as well as those close to you. I actually have an M1 referral link in the description of this video that anyone can use, and M1 normally runs promotions where if you click a referral link and then open a new normal brokerage account and transfer some cash into it, then we should both get some free cash given to us. By normal account I mean a non-retirement account. I think as of the time I'm making this video it's a free $20, but previously it's been $10. I've mentioned this before, but there's a famous story about Warren Buffett riding up a crowded elevator to his office, and on the floor of the elevator is a penny. When the doors opened, Buffett picked the penny up to the shock of everyone in the elevator, and as he walked away he held the penny up over his shoulder and said, "The beginning of the next billion." My point is, go spend the 15 minutes it takes to open a new brokerage account and then get your free $10 or $20 or whatever. Start your billion and don't pass up free stuff. $20 compounded at 10% for 50 years is thousands of dollars. For free, think about it. Okay, let's review some of the key metrics that are shown on this M1 interface before we look at your individual positions. It looks like you're up 12.5% over the last 3 years. Now, one thing to be aware of is that M1 does not rebalance or reinvest the dividends in the performance gains they show. So the chart only measures the capital gains and expense ratio over the time period selected. Or to say that more simply, the 12.5% isn't your real total returns including dividends received. Instead, it's just how much stock prices have changed. Let's look at how the S&P 500 has performed for a quick comparison. I'll show you how you can manually calculate returns rather than use an online calculator. So type in S&P 500 into Google. Then select a time range of 5 years to change how far back the graph shows. We can see that the price of the S&P 500 is around $33.20 on the day I captured this screenshot. Then move your mouse over the graph and hover over a time frame that is about 3 years ago, and we find the S&P 500 was about 2,500. So the formula to figure out the percent increase in something is just the new number minus the original number, then you divide that by the original number and multiply it by 100. So we take 3320 minus 2500 and we get 820, then divide 820 by 2500 and we multiply that by 100 and we get about 33%. So that tells us that the S&P 500 has increased by 33% over the last 3 years, which also means you've been underperforming the markets. Now 3 years is a relatively short time frame, but it's something to be aware of. A simple option you could consider is just holding VU and nothing else to basically get market returns. Okay, we see that you have your holdings in 2 slices or groupings, one which you call funds, that is 54% of your portfolio, and the other called stocks, which is 46% of your portfolio. It says you have 34 holdings altogether, and your portfolio's average weighted dividend yield is 3.247%, and your expense ratio is a decently low 0.08%. Let's look at your fund slice first. We see your funds are up 13.39% and you have 12 funds. The biggest holding you have is VYM, which is Vanguard's high dividend yield ETF, and that's 20% of your fund slice. Then you have NOBL, which is an ETF of S&P 500 dividend aristocrats, aka companies that have paid dividends and grown them for at least 25 consecutive years, many at 40 years or more. Then you have SPHD, which is a high yield ETF, but that has had negative returns over the last few years. It's 15% of this slice. Then you have VIG, which is Vanguard's Dividend Appreciation Index Fund at 14% of your slice. Then you have SCHD at 14%, which is a dividend ETF from Schwab. ETFs often have expense ratios which are management fees, though companies like Vanguard are known to have reasonable amounts they charge. Then 5% of your slice is a Vanguard bond ETF, and then VTI at 4%, which is a total stock market ETF. And then the last 5 ETFs are bonds, which in total make up 9%. My first thought is that you went overboard with too many ETFs. You could simply have VTI or VU and be done with it. Granted, they have lower yields. I'm personally not a big fan of bonds, as long-term equities blow bonds out of the water, so unless you're near retirement age, I would question your bond allocation. That being said, holding bonds right now as a risk mitigation against the pandemic is understandable. Also, some people that are a lot better investors than me, like Ray Dalio, have bonds as part of their investment strategies. So, I don't do bonds, but just because I don't doesn't mean you shouldn't. I personally never plan to own bonds, as I'd rather invest in companies like McDonald's or Johnson & Johnson or whatever, as I feel confident in them. And I'm confident enough in my top 10 stocks that I wouldn't switch over to bonds even if I was retired. Speaking of top 10 stocks, let's look at your individual positions now. We see your stocks are up 11.5% over the last 3 years, and you have 22 stocks in this slice, with an average weighted dividend yield of 3.6% and no expense ratio, as we would assume. Let's look at your top stocks first. So just glancing at these stocks, I can tell I like them. Of course, if you're really analyzing a company, you would look for cash flow growth trends and long-term increases in revenue and profits and such, but I won't do that here. You can watch my deep analysis videos to see what I like to look for in a company before I invest. First, you have Kimberly Clark, which is a good consumer staples company I also own and is currently my 10th largest position in my dividend portfolio. Then you have Coca-Cola, another great consumer staples company I own and the 9th largest in my portfolio. Then you have PepsiCo, my 5th largest, and the strong company that is like Coke, only more diversified. Coke will always have a special place in my heart because Diet Coke is my favorite soda. Then Disney, a company and brand that my whole family loves, but one that has suspended their dividend temporarily due to the pandemic and is my 24th largest position. They're such an amazing company covering so many areas, and I'm confident that when the pandemic is behind us, they'll spring back to life. Then you have Johnson & Johnson, which is a favorite healthcare stock of many investors and is my 3rd largest dividend stock by portfolio value. And then you have AT&T, a popular telecommunications company, which is currently my 12th largest position, and one which I'm hoping will kick into gear if management keeps driving down debt with their cash flow. They have underperformed for a long time, but one I'm willing to now bet on. Then you have another big gorilla in the telecom space in Verizon. Verizon is a great 5G pure play and are doing what they do best, concentrating on their core competency. Then you have a favorite of many DGI investors with Altria. And you follow that up with another strong company in waste management, which is an industrial's favorite of many investors. Then you have one of the utilities I love in Southern Company, which is my 13th largest dividend position. I've been thinking about investing more in them lately. And finally, you have one of my favorites in Procter Gamble, which has been doing crazy good and is my 4th largest dividend stock by portfolio value, so it shows you how much I like them. Now let's look at your next 11 stocks. So you have a strong healthcare company in AbbVie, which manufactures the best-selling drug in the world in Humira, which is projected to become the best-selling drug of all time in 2024 when its cumulative sales should pass the current number 1 of all time, which is the heart treatment drug Lipitor. AbbVie is currently dealing with patent issues with Humira, and they need to find other strong drugs in their pipeline or they risk revenue hits. Then we have one of my favorite companies in McDonald's, which I used to think was resistant to anything the economy could throw at it until the pandemic came along. But I still love them. They're my 7th largest position in my dividend portfolio, and are another one I really should invest in more. Then we come to Leggett & Platt, which is also in my top 20 at number 16 right now, so one I consider solid. After that we have PPG, which is a well-known materials company, and one that is respected amongst some dividend investors. And you have Honeywell, which I think of primarily as a strong aerospace play, but they are in a variety of other industries as well. Then you have Bristol-Myers Squibb, which is a well-known healthcare company. Then you have Wells Fargo, which unfortunately cut their dividend in July, which they also did back in 2009. Lately, JPM has been looking more compelling to me, though I only hold Goldman Sachs right now. Then you have Ford, which suspended their dividend this year. They haven't looked good for a while now, but I hope they recover. I remember I used to watch a YouTube channel of a guy who had a large Ford position. I hope he's doing okay still. I really like Ford cars though, and the GT40 is probably my favorite car. But while liking a product is nice, it isn't how I make my ultimate investment decisions. Then you have one I do like and own in Realty Income. I actually just released a minor update video on O due to a milestone I hit, and that video is really taking off. Realty Income is a great REIT. Then you have Marathon Petroleum Corp, which, like almost all oil-affiliated stocks, has been beaten down by the 1-2 punch of a Russia-Saudi Arabia oil war combined with the pandemic. But at some point I imagine oil prices will come back, and they say that sometimes the best time to buy is when everyone else is selling. Finally, you have Microsoft, which is a favorite tech play of mine and is my number 2 largest in my dividend portfolio by value. Now that we've looked over your portfolio, I would recommend that you consider diving into some non-dividend growth stocks like Google, Facebook, and Amazon, all of which I'm long in. Perhaps wait until their prices look compelling to you, and of course, don't buy them because I like them or don't like them. Just research them and see what you think. I think your stock slice looks great overall, and I think your fund slice has way too many, including some I'm not into. So it's close, but I'll have to swipe left, but I do think you're on a great path overall, and I applaud you for investing. I could also go right, but I'm being a picky patty today. So what do you guys out on the interwebs think? Vote on my community tab if you would swipe right because you think you would take this entire portfolio out for a date and wine it, dine it, and get married? Or would you rather just stay home and play Call of Duty with your mates? Either way, I'll leave you with this quote. If you are depressed, you're living in the past. If you're anxious, you're living in the future. If you're at peace, you're living in the present. Reflect on that quote over a nice cup of joe. Thank you so much for watching all the way to the end. Leave me a comment if you did, I'd really appreciate it. These videos take a lot of time and energy for me to create, so liking my video is a simple way you can thank me. Also consider subscribing and clicking that bell notification. If you'd like to help support my channel more, then please consider clicking on my Amazon affiliate link in the description of this video, which then allows me to earn from qualified purchases when you shop there. Finally, don't forget to check out my Dividend Discord server. Give it a try, I think you'll like it. Thanks, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.